Hi, I'm Jack from CryptoCollege.cc. In this video, we explore the critical role the supply dynamics of a currency or commodity play in determining its value. More specifically, we compare the issuance and supply mechanisms of the United States dollar, gold, and Bitcoin, examining how these factors impact their role as stores of value and mediums of exchange. Let's start with the dollar. Like most fiat currencies, it is characterized by a flexible supply. It is controlled by monetary policy decisions made by the Federal Reserve, the central bank of the United States. The supply of USD is not fixed and can be adjusted based on economic needs. During periods of economic downturn or financial crisis, the Federal Reserve can increase the money supply through mechanisms such as lowering interest rates or through quantitative easing, also called QE. QE involves the purchase of government securities or other securities from the market to increase the money supply and encourage lending and investment. The issuance of new dollars relative to its existing supply has significant implications. For instance, increasing the money supply can lead to inflation if the growth in money outstrips economic growth. This has been a concern particularly in scenarios like the post-2008 financial crisis and the recent COVID-19 pandemic response, where large-scale QE was implemented. We can look at the M2 indicator to have an estimate of how the supply of dollars has grown over the years. M2 is the U.S. Federal Reserve's estimate of the total money supply, including all the cash people have on hand, plus all the money deposited in checking accounts, savings accounts, and other short-term saving vehicles. Retirement account balances and time deposits above $100,000 are omitted from M2 calculation. According to Investopedia, the M2 money supply has grown from $4.7 trillion in January 2000 to $20.8 trillion in March 2024. During that period, there was a notable jump from $15.3 to $18 trillion in 2020 caused by the pandemic stimulus checks. This translates into a growth of about 340% of the money supply since 2000 and a compound annual growth rate of more than 6%. Now that we have some idea of the growth in supply for the USD, let's have a look at gold. Gold differs from fiat currencies as it is a physical commodity with a supply that cannot be altered with the same flexibility. The supply of gold grows through mining output, which has historically grown at about 1 to 2% per year. This relatively fixed rate of supply growth means that gold cannot be devalued through large increases in supply by any single entity or government. This inherent scarcity is one of the key reasons gold has been considered a store of value for a long time. Unlike fiat money, gold's status as a precious metal means its utility and value are derived not just from its function as a currency, but also from its uses in jewelry and industrial applications. However, the bulk of gold demand comes from investment and monetary uses, particularly as a hedge against inflation and currency devaluation. Let's now estimate what is the yearly issuance of gold. If we look at the above-ground stock of gold, which is about 212,000 tons, and we put that against what was extracted in 2023, about 3,000 metric tons, we can estimate an annual growth of the supply of 1.4%. This is right in the middle of the yearly averages of 1 to 2%. Again, we have added the sources for this data in our video description. If we compare the yearly issuance of gold to the dollar, it is about 4 times smaller. We can then say that gold is an asset 4 times harder than the US dollar. So how does Bitcoin compare in terms of issuance? Bitcoin, often referred to as digital gold, shares some characteristics with both gold and fiat currencies, but also has unique attributes. Bitcoin has a capped supply, with a maximum limit of 21 million Bitcoins ever to be issued. This cap is encoded in its software and enforced by a network consensus mechanism, making it immune to manipulation or inflationary policies. Bitcoins are introduced into circulation through the process of mining, a computationally intensive process where miners solve cryptographic puzzles to process transactions and are rewarded for doing so with new Bitcoins. This process is designed to mimic the resource-intensive process of gold mining. However, unlike gold, Bitcoin's issuance rate is predetermined and decreases over time through an event known as the halving, where the rewards for mining new blocks are reduced by 50% approximately every 4 years. The predictable issuance model and finite supply of Bitcoin contrast sharply with the flexible issuance policies of fiat currencies. This design intends to offer an alternative to traditional fiat systems by providing a predictable and transparent supply that cannot be influenced by any central authority. Let's look at 2023, for example. The issuance in 2023 was about 320,000 Bitcoins for an existing supply of 19.6 million out of the 21 million maximum. This represents an increase in supply of 1.6%. However, after the April 2024 block reward halving, the yearly issuance has dropped to about 160,000 Bitcoins per year, or 0.8% increase in supply. This is the first time since its launch that the issuance of Bitcoin has fallen below that of gold. In 4 years, in 2028, it will drop to 0.4% and will be further halved every 4 years until it reaches zero, with all Bitcoins being created by the year 2140. With a yearly issuance that is almost half of that of gold, we can now say Bitcoin is 2 times harder than gold. The differences in issuance and supply mechanisms among the USD, gold, and Bitcoin lead to varying implications for their stability and use as stores of value. From the above calculations, we know that the supply of USD grows annually by about 6% and is accelerating to cope with the debt. Gold supply grows by a stable 1.4%, and Bitcoin, as of April 2024, grows by 0.8%. One notable difference is that Bitcoin's issuance will continue to reduce by 50% every 4 years. While the flexible supply of USD allows for responsive monetary policy, it also introduces risks of inflation and devaluation. In contrast, the fixed and predictable supplies of gold and Bitcoin provide protections against inflation but also mean that their supplies cannot be adjusted in response to changes in demand or economic conditions, potentially leading to greater price volatility. Moreover, the decentralized nature of Bitcoin and the physical and universal appeal of gold offer alternatives to fiat currencies, which are tied to the economic stability and policies of specific countries. As digital transactions become more widespread and geopolitical tensions influence financial policies, the appeal of decentralized or universally recognized stores of value may increase. Understanding the issuance mechanisms and supply dynamics of the USD, gold, and Bitcoin reveals deep insights into their roles as currencies or investments. While the USD offers flexibility and responsiveness to economic conditions, gold and Bitcoin provide scarcity and predictability, appealing to those wary of inflation or governmental overreach. Each serves different needs and comes with its own set of risks and opportunities, shaping its suitability for investors and users across different contexts. With each video we publish, there is an opportunity for our community of learners to earn some Bitcoins. Make sure you follow us on Twitter and search for the hashtag LearnEarnWithCC. If you want to learn more about the cryptocollege.cc Learn and Earn Bitcoin program, please click on the link in the description below. We hope you learned something from our video comparing the USD with gold and Bitcoin, and if so, please give it a thumbs up or even better share it to create awareness. If you are interested in learning more about how to manage your finances and cryptocurrencies, why not subscribe to our channel? That's it for today. I wish you all the best in your journey to financial independence, and I'll see you in the next one.